The Consumer Price Index, or CPI, is a crucial economic indicator that affects everyone. It measures the average change in prices paid by urban consumers for a basket of goods and services, reflecting the cost of living. Think of it as a shopping cart filled with everyday items like food, housing, transportation, and healthcare, which are essential for daily life. By tracking the price fluctuations of these items, the CPI provides valuable insights into the rate of inflation, which is simply the rate at which prices increase over time, affecting our purchasing power. The CPI is used for a variety of purposes, making it a versatile tool in economic planning. Businesses use it to set prices and negotiate wages, ensuring they stay competitive and fair. Governments rely on it to adjust Social Security benefits and tax brackets, helping to maintain economic stability. Investors closely monitor it to make informed decisions, as it impacts market trends and investment strategies. In essence, the CPI serves as a barometer of the overall health of the economy, reflecting the purchasing power of consumers and the stability of prices in the marketplace, which is vital for economic planning. Understanding the CPI is fundamental to grasping the dynamics of inflation and its impact on our daily lives. When prices rise, our hard-earned rupees don't stretch as far, making it harder to afford the same goods and services. It erodes the value of our savings and diminishes our purchasing power, impacting our financial well-being. Therefore, keeping a close eye on the CPI is crucial for both policymakers and individuals alike, as it influences economic decisions and personal finances. The November 2024 CPI report, released on December 11, 2024, presented a mixed bag of data, leaving economists and investors pondering the trajectory of inflation. This report is crucial, as it provides insights into the economic health of the country and influences key financial decisions. The headline CPI, which includes all items, rose by 2.7% year over year, a slight increase from the previous month. This uptick, though modest, signals that inflationary pressures are still present in the economy. This figure indicates that, on average, prices for a wide range of goods and services are 2.7% higher than they were in November 2023. Consumers are feeling the pinch as everyday items become more expensive. The core CPI, which excludes volatile food and energy prices, remains steady at 3.3% year over year. This stability in core inflation is a double-edged sword, providing some relief but also indicating persistent underlying inflation. This measure is closely watched by the Federal Reserve as it provides a clearer picture of underlying inflationary pressures, stripping away the short-term fluctuations often seen in food and energy markets. Policymakers rely on this data to make informed decisions about interest rates. On a month-over-month basis, both the headline and core CPI increased by 0.3%. This consistent rise, although small, adds up over time and can significantly impact the economy. While these figures may seem small, they indicate that inflation is not cooling down as quickly as some had hoped. Businesses and consumers alike are feeling the effects, leading to increased uncertainty in the market. The persistence of inflationary pressures, even at a moderate level, raises concerns about the cost of living and the potential for interest rate hikes. Households are finding it harder to manage budgets, and the Federal Reserve may need to take action to curb inflation. To understand the complexities of inflation, it's essential to delve into the specific sectors driving the price increases. In the November 2024 CPI report, several key areas stood out as significant contributors to the overall inflationary trend. Car prices, a major component of the CPI, experienced a substantial 2% monthly increase. This surge can be attributed to a combination of factors, including ongoing supply chain disruptions, increased demand for new vehicles, and rising input costs for manufacturers. Airfares also played a role, climbing by 1% month over month as holiday travel demand remained robust. Another notable contributor to inflation was the cost of auto insurance, which rose by 0.5% in November, following a substantial yearly increase. This persistent upward trend in auto insurance premiums is putting a strain on household budgets, particularly for those who rely heavily on their vehicles for transportation. The November 2024 CPI report highlighted the stubborn nature of inflation, prompting discussions about why price pressures are proving so difficult to tame. One key factor contributing to this sticky inflation is the concept of sticky prices. In many sectors of the economy, prices are slow to adjust downwards, even when demand softens or input costs decline. This phenomenon can be attributed to various factors such as wage price spirals where rising wages lead to higher production costs, which are then passed on to consumers in the form of higher prices. Additionally, supply chain bottlenecks and geopolitical uncertainties continue to exert upward pressure on prices. The war in Ukraine, for instance, has disrupted global energy markets and exacerbated inflationary pressures worldwide. These factors, combined with strong consumer demand fueled by pent-up savings and government stimulus measures, create a complex web of inflationary forces that are proving challenging to unravel. Section 5. Gazing into the crystal ball, future inflation expectations. As we move further into 2025, the trajectory of inflation remains uncertain, with economists offering a range of projections. Goldman Sachs, for instance, predicts further disinflation in 2025, citing easing auto and housing costs and a softening labor market as key drivers. However, concerns linger about the potential impact of the president-elect's policies on inflation. Some analysts worry that increased government spending and potential trade tensions could reignite inflationary pressures, offsetting the disinflationary forces at play. The Federal Reserve's actions will undoubtedly play a pivotal role in shaping the inflation outlook. Market participants are closely watching for signals from the central bank regarding the pace and magnitude of future interest rate hikes. Section 6. The Fed's Balancing Act, Taming Inflation Without Stifling Growth. The Federal Reserve faces a delicate balancing act as it navigates the current economic landscape. Its dual mandate is to maintain price stability, which means keeping inflation in check, and to promote maximum employment. In response to the stubbornly high inflation, the Fed has already raised interest rates twice this year, in September and November. These rate hikes are intended to cool down the economy by making it more expensive to borrow money, which theoretically should curb consumer spending and business investment. However, the Fed must tread carefully. Raising rates too aggressively could tip the economy into a recession. On the other hand, moving too slowly could allow inflation to become further entrenched, eroding consumer purchasing power and undermining economic growth. Section 7. Expert Opinions, Diverse Views on the Inflationary Landscape. Expert opinions on the current inflation environment vary widely, reflecting the complexity of the issue and the uncertainty surrounding future economic conditions. This diversity of thought is crucial for understanding the multifaceted nature of inflation. Some economists express concerns about the persistence of inflation above the Fed's 2% target, arguing that the central bank needs to act more decisively to rein in price pressures. They believe that without strong action, inflation could become entrenched. Others caution against overreacting to short-term fluctuations in inflation data, suggesting that the Fed should allow the economy to run hotter for a while longer to support job creation and economic growth. They argue that a measured approach could yield better long-term results. The debate over the appropriate policy response highlights the difficult trade-offs facing policymakers. Balancing the need to control inflation while fostering economic growth is a delicate task. The risks and benefits of rate cuts in the current economic climate are also subject to debate. Some argue that rate cuts could stimulate the economy, while others warn of potential inflationary consequences. While lower interest rates can stimulate economic activity, they can also fuel inflation. This dual effect makes policy decisions particularly challenging. Finding the optimal balance between supporting growth and containing inflation remains a key challenge for the Fed. This ongoing struggle underscores the complexity of economic policy making in today's world. Section 8. Conclusion. Navigating the uncertain waters of inflation. The November 2024 CPI report serves as a reminder that inflation remains a significant economic challenge. While price pressures have moderated from their peak earlier this year, they remain stubbornly high, eroding consumer purchasing power and complicating the Fed's policy decisions. Understanding the CPI and the forces driving inflation is crucial for navigating these uncertain economic waters. By staying informed about economic indicators, policy decisions, and expert analysis, we can make more informed financial decisions and advocate for policies that promote a stable and prosperous economy. The road ahead may be bumpy, but by staying informed and engaged in economic discussions, we can collectively navigate the challenges and opportunities presented by the ever-evolving economic landscape.